Market sentiment improves, even if the data haven't. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele, and I'll still see you at 8:31 tomorrow.
8:31 tomorrow. I'm not sure what's going on.
That's when the action is going to happen.
Is that PM,
I appreciate
AM?
that the volume is higher for tech stocks, but overall volume is still pretty weak for the Dow as well as for the S&P. But the S&P is up by about 0.5%. Some really fun things, though, going on in the market. One of them is Paramount. That stock taking a dive down 5%. You had CNBC reporting that perhaps Sony will walk away from a potential deal. And I wanted to highlight copper. So copper's down 0.7, but if you look at copper in the U.S., that's up by a significant amount. Had a huge spike in the last 24 hours. Very strong backwardation. Super high prices now versus prices in the future. That's always fun. That's a short squeeze. We like talking about that. And the U.S. yield on the 2-year is down by 4 basis points. So pretty much bid across the curve after that PPI and into CPI tomorrow, Romaine.
And of course, a lot of those macro factors really swirling around as Alex waits for 8:31 tomorrow a.m. Of course, there is a lot out there today with many investors really trying to cobble together a narrative of inflation, business sentiment, and economic conditions that, at least for now, suggest optimism might actually be warranted. There was a Bank of America survey released today, that weekly survey that comes out, and it shows global fund managers are the most bullish going back to November of 2021. And for Bank of America strategist Michael Hartnett, that might not actually be a good thing. In fact, it might be a problem for him. He says that bullishness is backed by an increase in optimism for rate cuts this year. Rate cuts he doesn't think are going to happen. But he says that gets canceled out by the drop in investors' outlook for economic growth and corporate profits. And that really leaves risk assets, according to his opinion, vulnerable to a stagflation scenario. There's that word once again here. But take two of the economic data points that we got today. The NFIB's monthly small business sentiment index, that rose for the first time this year to 89.7, but it still remains well below the long-term average of 98. That's to the point that Michael Hartnett is trying to make. Then there was the reading on U.S. producer prices, which rose the most in 12 months. However, several PPI categories used to calculate the Fed's PCE data, that eased, and that includes airfare. It includes hospital outpatient care and a few other key metrics here. Fed Chair Jay Powell, speaking at an event in Amsterdam, called Tuesday's report, quote, mixed, and then reiterated it's going to likely take longer than previously thought to attain the confidence needed to lower interest rates. But I guess at least he's not talking about a rate hike anymore. But we do want to start the show off here with geopolitics, given the unveiling today by U.S. President Joe Biden of those sweeping tariff hikes on a range of Chinese imports. And it's not just steel and aluminum. It's semiconductors, batteries, Alex, solar cells, and yeah, some of those critical minerals as well.
Yep, but very targeted, which was really quite interesting and phased in over time. This is a great board that just kind of shows you what we're looking at here. So for semiconductors, you're looking at a double of the tariffs. Old rate was 25, then you got 50. You skip to EVs, that whopping difference. But remember, we don't actually import that many Chinese EVs. Mexico does. Maybe it makes its way there. Solar cells, for example, up to 50% from 25. Then you have ship-to-shore cranes, for example, syringes and needles, surgical gloves. But what this seems to want to do, Romaine, is to tread the line of we want to be able to protect our industries here, but not necessarily add that much to inflation by targeting industries that we don't yet have a replacement for. And that's why the timeline to this was so interesting. But it also raises the question to me, Romaine, can you decarbonize and also deglobalize at the same time? Or is all of this at the end of the day just going to be inflationary?
Well, that's a big question here, and that's the balance maybe they're trying to achieve, or maybe it is just political. We do know that these tariffs are going to be politically contentious. They already are. But our next guest says that the extraordinary government subsidizing of semiconductor production is actually supporting economic growth here in the U.S. and abroad. And, well, that could prove to be a long-term ballast for the market, but it could make the Fed's job a bit harder when it comes to fighting inflation. Maria Vassalou joining us right now, head of the Research Institute at Pictet Group, joining us here in Studio 2 in New York. Great to see you again, Maria.
Great to be here.
I am curious here about some of the subsidization that we're seeing, not only just here in the U.S., but you're seeing that in Europe, you're seeing that in Asia, particularly in China as well, and how, if at all, that will complicate what most central banks have been trying to do for the last 2 years, and that's keep inflation under control.
Well, this is part of the reindustrialization process that is going on. It's an industrial policy that you see around the world. It's not just China that has been supporting certain industries, but we see that also in the US, we see it in the EU, and of course as part of the deglobalization process, a fragmentation that we see around the world, and underlying all that is the geopolitical tensions. And of course that makes the job of the Fed and of all the central banks so much harder, because this process is actually highly inflationary.
It is highly inflationary. There are longer-term strategic reasons why the Biden administration is pursuing this, and we should point out this is more or less just an expansion of the tariffs and other restrictions that were put in place by his predecessor. Is there not a growth story there? Is there not sort of hope that maybe the economic benefit maybe outweighs, I guess, whatever inflationary impact?
Absolutely. And that actually makes the job of the Fed even harder, because we have a process where we have higher inflation. The Fed is trying to lower inflation at the same time that we have a lot of growth processes underway in the economy. It's all these subsidies, but it's also all this innovation boost that we see from the semiconductor area, AI, biotech. So all these things are really going to increase productivity. They're increasing growth, and that's why we see also all this resilience in the U.S. economy. So that doesn't make the job of the Fed very easy.
So will they cut it all this year?
I don't really see a reason to cut. If anything, I would say that until recently, the monetary policy hasn't been particularly restrictive. It's only now that the U.S. consumer has worked through its savings, and we're seeing some tightness in the market. So the Fed has to thread the needle very carefully to sound hawkish on inflation, because if they are perceived as being soft on inflation, that can have really terrible ramifications for the sustainability of U.S. debt. But at the same time, they don't want to be so hawkish that they risk a sell-off in the market that can tighten financial conditions abruptly.
So string together all the different threads here, because that's what you do now as head of research, right? You used to work at Goldman, you used to work at Perella, you had your own hedge fund. Broader strokes, you're looking at what? Structurally higher inflation? Are we looking at consistent, unsustainable U.S. deficits? And then what the broader take of that is? How do we address all this in the next few years? Like, what are your big takeaways?
Well, we were in a very nice global equilibrium where the U.S. could actually import capital from the rest of the world, invested in high growth industries, and the rest of the world could benefit from that. And the U.S. was running budget deficits. With all this global tensions and fragmentation, this equilibrium is becoming much more fragile, and I think we're going to see a lot of tensions and risks going forward, and that also means a lot more volatility in the markets and potential smaller or bigger crisis ahead.
Does that, I'm just curious though, does that sort of narrow the Fed's mandate? Are we going to get to the point where it's not a dual mandate, it's a single mandate?
I think between the two mandates, the Fed will have to prioritize inflation now. And that also means that they have to be very careful not to really trigger any big defaults in the market that will force them to step in and provide more stimulus and therefore further increase the debt of the U.S. But at the same time, they really cannot afford to be seen as being soft on inflation.
All right, Maria, thanks a lot. It was wonderful to see you. Thank you so much for joining. It's been way too long.
Thank you for having me.
Vassalou, Head of Research Institute over at the Pictet Group. What was interesting, too, is when you heard from Jay Powell today, when he talked about the financial conditions being tight, he specifically said the jobs market, and that's really where you're seeing it, just maybe not in other areas of the economy.
Yeah, absolutely here. And of course, we are waiting to hear from Alex.
Okay, President Biden announcing new tariffs on China. Let's go to that right now. Bloomberg Balance of Power host Joe Matthew and Kelly Lyons are standing by with U.S. Trade Representative Katherine Tai.
Indeed, Alex, thank you so much. We welcome now from the White House North Lawn, the Ambassador, U.S. Trade Representative Katherine Tai. Ambassador, welcome to Bloomberg. Thank you so much for being with us on a day that President Biden has announced an expansion of existing tariffs on many Chinese imports. China, in response, has said it will take resolute measures to defend its rights and interests. What response in retaliation are you expecting from China? What is the worst China could do?
Well, I don't want to speculate on what the worst China could do, but we are interested to see how China responds. We have indicated to China that this is not an intention to escalate or even to confront. It really is on our side. A set of defensive measures, when taken together with the investments that we are making here in green and clean technology, is meant to create the space for our workers and our businesses to be able to thrive in the global economy and to compete in the marketplace.
While you create that space, though, Madam Ambassador, the reaction from Beijing has been real, to Kayleigh's point. And with your decision to not only roll out these new levies today, but keep the Trump-era tariffs in place, how is this not the start of a trade war?
Oh, well, you've got to take it back to the technicalities of what we are doing, which is conducting a review required by our statute at the 4-year mark of the tariffs. And we were required to examine the effectiveness of those tariffs in terms of influencing China to improve its intellectual property rights abuses practices and its forced tech transfer practices, and also to examine the effects of those practices on our economy. What we found was ongoing abuses, and in many cases where the practices have not subsided, that they have actually gotten worse with cyber hacks and cyber attacks. So in addition to that, we looked at the effects on the U.S. economy, and we see the harms of the non-market policies and practices that the intellectual property rights abuses are a part of, and the need for the United States to take definitive action to defend. We know that not taking action is going to allow the takeover of so many strategic sectors by Beijing that we have seen before: steel and aluminum, solar, and now batteries and EVs.
Well, I'm sure you remember the controversy this started with the Trump tariffs in 2018. Your decision to keep them in place, just to be clear, Ambassador, proves that the Trump administration had the correct approach, right?
I disagree with that. I very much disagree with that. The approach that the Biden administration is taking is one that is strategic, one that is aimed at using the tariffs as part of a policy tool set. We combine them with the investments that we are making, historic investments in the clean energy revolution, to ensure that the United States, America's workers and businesses, continue to have the space to compete and to grow in the industries of the future.
Well, that said, Ambassador, none of the existing tariffs were reduced today. There have been no offsets to the tariffs that are going even higher as a result of this review and ultimate decision. Without those offsets, how inflationary could this be?
Well, this is a question that I've heard a lot of. We don't see our approach as being inflationary. In fact, our approach is an investment in the United States' resilience, our economic resilience, and the resilience of our supply chains. That requires us to rebuild and reinvigorate American manufacturing capacity, as well as looking for diversification of sources of supply and sources of demand as well. That kind of resilience, when we build it into our economy, is going to help us avoid the kinds of price spikes and inflationary dynamics that we've experienced over the past couple years because of the supply restrictions that have come from these supply chain resilience problems, in large part because of the degree to which we are extremely dependent on China as a source of supply.
Well, Ambassador, as we talk about where supply is coming from, I wonder how you are considering supply that may actually come not directly from China, but other third world countries or third party countries, that is. Obviously, there is now a very large 102.5% tariff on Chinese made EVs. What if they're made in Mexico? How are you prepared to respond and address that specifically?
So that's a different type of a challenge. The Section 301 tariffs in action were with respect to trade directly between the United States and China. I know that this has been mentioned by many. We are all paying attention to the fact that there are Chinese industries, state-owned companies that are buying up land, establishing facilities in, to your point, third countries and looking for other ways of accessing the U.S. market. This is something that we are scrutinizing very closely at USTR.
This is obviously part of a supply and demand conversation here. And the fact is, Ambassador, if I want to go buy a Chinese EV right now, I'm not sure I'd be able to do that in the U.S. Were you anticipating a massive influx here like we've seen with other supplies? Bring us to the problem you're trying to solve.
Certainly. This is an issue that the administration has been extremely clear about in communicating to the American public, but also communicating directly to counterparts in Beijing, which is the concern that China is doubling down on its export-led model of growth to try to lead the Chinese economy out of its current downturn by manufacturing beyond the demand required in China and pumping goods out into the global market. What we have seen in the past with respect to these other industries, steel and aluminum, solar, critical minerals, is the ability for China on this massive scale to use predatory prices to drive out production in other parts of the world and then to corner the market. That is very much the concern that we and others in the global economy have, both in the developed world and in the developing world.
Well, Ambassador, there also is going to be a recommendation process for exclusions here, and you mentioned solar specifically. We do know that there are 19 possible exclusions for solar manufacturing equipment, but what other exclusions might be on the table?
So the solar manufacturing equipment, and there's clean energy manufacturing equipment that we will run a process for those who want to request exclusions. It's really meant to recognize that where we are today in terms of our resilience is not where we want to be. And to get from where we are to where we want and need to be is going to require a transition. You cannot just flip a switch. You can't flip a switch to have the resilience that you need to build towards. So that exclusions process is very much a recognition of the need to send a strong signal and to provide our producers with the ability to transition to manufacturing more here at home and having that kind of capacity. There is another set of exclusions that is set to expire on May 31. And I think that folks should look to USTR in the next week or two for announcements regarding that exclusions process.
We're out of time here, Ambassador, but do those exclusions include double-sided solar panels?
That bifacial issue with respect to solar is actually a part of a different trade program. And just to make clear, for those of us it matters, 301 versus 201. But that is something else that is under consideration.
U.S. Trade Representative Katherine Tai. Ambassador, we thank you for your time today on Bloomberg Television. I'm Joe Matthew alongside Kaylee Lyons in Washington. We'll send it back to Romaine in New York.
All right, our thanks there to the team over at Balance of Power. A great interview there with the U.S. Trade Ambassador. Stick with us here, though, on the close, counting you down to those bells with just about 40 minutes to go. This is Bloomberg. All right, shares of the sneaker company On Holding having their best day in more than a year on the back of a first quarter report that showed a 29% jump in revenue year over year. The co-CEOs, Hoffmann, Marc Maurer, I had a chance to sit down with them earlier today, and they talked about why they can continue that same growth pace. Take a listen.
The next few months, we really aim to take brand awareness and brand credibility to a whole different level, and the Olympics are a key building block in that. So we're very much looking forward, as Martin elaborated, to see the athletes compete. We're very much looking forward to also opening a second own retail store in Champs-Élysées. We're very much looking forward to give more details around the innovation and the product that Helen Obiri was wearing in Boston and show that to the world. And then we're also the official sponsor of the Swiss Olympic team. So this goes back to our Swiss roots and our Swiss heart.
It's kind of interesting. On Nike's last conference call, they talked a lot about some of the new entrants into the performance running space. They didn't mention your name specifically, but we knew who they were talking about. And they've kind of re-upped their own efforts to court, I guess, that more experienced athlete as a customer here. Does that worry you at all that a company of its size and scale has now sort of reawakened in this space?
It's a space that lives off innovation. And so I think in the end, we innovate and we push ourselves and each other to new levels. And this is, in the end, what you feel on your own feet when you are running. So we have a strong pipeline of innovation. This matters to us, focusing on our growth. And as we just elaborated in the beginning, we have a very strong momentum, and we expect this to continue for the years to come.
As far as your marketing strategy, are there any plans to sign bigger athletes, meaning beyond just the core sports that you've been involved in, such as track and running and tennis, of course? Any plans to expand beyond those sports?
Absolutely. We're always looking for athletes that are aligned with our mission, which is igniting the human spirit through movement. And so we'll bring more athletes into the tennis team. That's important to us. So we're very much looking in the long run at how can we bring more younger athletes on. We're also looking at how we expand the track and field roster. We have a couple of athletes that are already very successful in marathon, but that's also a space that we want to expand. So we continue to expand the athlete roster, but for us, it's very important we're not just signing people, but we have to have aligned values. And so we'll take our time to bring the right people to On. One thing I haven't seen with On much, if at all, is any sort of significant discounting. That does not necessarily seem to be a part of the strategy. Is that the case? And if so, any plans to change that?
Absolutely. So we are a premium performance brand. We want to be the most premium performance brand. That's our goal. And we have a very low level of discounting. We are very proud of this. As a result, we are driving a superior gross profit margin of 60%. And there are many elements from the product to the distribution to the engine that runs behind that are built to ensure that premium position. But it's very much at the core of our strategy. So talk about sort of what's next, longer term for this company. You guys have grown tremendously over the last few years. You had a big public offering and the stock still seems to be holding up here. As you really try to expand and scale up this brand, what really gets you there here? I mean, because this isn't just about selling more shoes. There's a lot more to it than that. Yeah, we announced our long-term plans at an investor day a couple of months ago, and just highlighting a few key pillars. I think On is built around running. That's who we are. So one very important area is that we continue to grow in run. We want to continue to win on runners' feet. And in the latest runners count that we did in many cities of the US, we have over 10% share. So we're very happy with that, but that's not the end. So we feel we can go much, much higher. Then own retail is very important to us. So we feel in the whole distribution, we can continue to grow our own direct-to-consumer share, and own retail is playing an important role in there. We very strongly believe in our apparel business. So you see both of us wearing some of our latest pieces here, and we have very good signs that apparel will continue to grow over proportionally to footwear, or start to grow over proportionally to footwear. And then we're happy that we have a broad geographic footprint. So On is present in China, On is present in the US, and that will help us to grow, especially balanced across many different regions. And China is expected to become 10% of our business in the midterm. All right, and that was Martin Hoffmann and Marc Maurer. They're the co-CEOs over at On Holding, Alex, and this is kind of a company that kind of came out of nowhere. I mean, they're really only like 10 years old. Remember, they were hugely popular in Switzerland, and then Roger Federer basically invested in the company and started promoting it, and it went global. And now they're in 60 countries, and they're nipping at the heels of a lot of the big players. And it's not the only company, right? Hoka just kind of came on the scene, and now they're eating Nike's lunch. Yeah, it just also shows that if you have a specialty product in a certain area, you can still do well, even if the economy or the consumers are retrenching. Like that's, I feel like, what we're learning throughout earnings season, et cetera. All right, there's been some breaking news crossing the wire. This on TikTok and ByteDance and the efforts by the U.S. government
to get the Chinese government to divest TikTok. We're now learning that a group of TikTok creators have now filed a lawsuit challenging the U.S. law that would force the Chinese parent ByteDance to divest itself of the video app here in the U.S. by January or face a ban. Of course, this is a developing story. We should point out there's already lawsuits out there by the company itself, but now the TikTok creators themselves are now jumping on board with this. We're going to try to get you some more details, and we'll bring you that information as soon as we get it. When we come back, an interview with the CEO of Train. Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele.
Did you see that? You know how warm it is outside right now?
I do not know how warm it is outside.
Okay, all right.
I have not been outside since this morning.
We'll let you go around 4 p.m. How about that?
It's really 4:10. But
okay,
yeah.
all right.
All right, so we got the PPI data out today, Producer Price Index. We're kind of waiting for the CPI. The PPI comes in a little bit hot. Got more data coming tomorrow. Fed Chair Jay Powell spoke at an event in Amsterdam, and he begs to differ with that hot description.
I would say it's actually quite mixed. The headline numbers were higher, but they were backward revisions, and we're of course disassembling it, taking it apart, and looking at it. And I think markets and analysts are looking at it as I wouldn't call it hot. I would call it sort of mixed.
And on days like that, we love to get some on-the-ground perspective on the print. Here in studio with more is Dave Rigneri, the chair and CEO of Train Technologies. Train Technologies is an HVAC company, heating, ventilation, and air conditioning. That stock is up 34% this year. Recently reported earnings firing on all cylinders. Great to see you. Thank you for joining us.
Oh, thanks for having me on your show. Really appreciate being here.
The news of the day. What areas are you still seeing maybe disinflation in the inputs in your business? Are you seeing any inflation? How would you categorize everything?
We're certainly seeing some inflation, especially on the labor side. From a commodity standpoint, yeah, copper's up, steel's down, so that's kind of normalizing itself. But, what we've been able to do at Train Technologies is we've built a business operating system. So we really have great insights as to what the cost in is, so we can make sure we're pricing our product correctly.
So what is your visibility in that in terms of how you're
Yeah, we have our product growth teams, as we call them. It's really expertise that is able to really, what I call, look around the corner. So they could be able to understand what those cost inputs are going to be. Now, on a commodity basis, we'll do hedging so we can plan accordingly. But we really stay in tune with what's happening in the market so we can understand what the cost of our product is to make sure that we stay ahead of any pricing that's required.
Where's the growth coming from right now? Is it primarily sort of new customers, new sales, or is it sort of replacement of existing equipment? Where is it at?
Well, Romain, we had a very strong first quarter. As Alex said in our opening here, our organic revenue growth was up 14%. Our organic order rates, or our bookings coming in, were up 17%. And our EPS growth was 38%. So we had a very strong first quarter. And the good news is that I would call the growth as broad-based. So we track in North America here, we track about 14 different verticals. And I would tell you that almost all of the verticals had strength. We had growth in all but two, and that was marginal. And that would be traditional office, that was a bit softer, and lodging, that was a bit softer. But we saw growth, whether it be in the high-tech, industrial, data centers, education, healthcare, government, K through 12, as well as higher ed.
What does that say, though, about the economy? I mean, one reason why we love talking to people like you is because the type of business you're in, I mean, you kind of have that eagle-eye view of really what's going on the ground.
I mean, we're seeing a lot of strength. And if you look at our growth rates, I'm very proud of what our team's been able to accomplish. I would tell you that it has a lot to do with your innovation pipeline as well. So we invest heavily in our business. We're not episodic at all in our investments. We're very consistent, and we invest for the long term. I often get asked, well, why can't you leverage more or give more OI for every incremental dollar of sales? And I'm always like, no. Our model is 25%. Because we always want to make sure that we can reinvest in our business to make sure we stay ahead.
I should point out, that kind of makes you somewhat of an outlier these days among big CEOs. I mean, everybody now is just pushing that cash back to investors, and you're saying there's a need to keep that.
It's like, for example, we have one of our businesses, our Thermo King business, which is in transport refrigeration. It's a business that's in a down cycle, okay? So it did not have growth in the first quarter. now's the time to continue and reinvest in your business. It will come back. It will be very strong. Right now, all indications are it comes back in 2025. We'll be ready, and we'll be, ready to really come up with competitive advantages in 2025.
To be fair, DC has helped you guys. I mean, back in the pandemic, it was all like, let's retrofit all the schools to make sure we have good ventilation systems. Then it's also about the IRA. We all need to sort of decarbonize and get better air filtration systems. This is all like gold to you, right? So how much of that is coming from the government? How do you book that revenue?
Certainly, I always tell people that if you're going to build your business model around policy or rebates coming from whether it be the government or state levels, typically long-term, that's a bad business model.
Sure, but it's definitely helping, right?
It's a tailwind. We look at it as a tailwind. If I look at ESSER funding, right, which is for the education vertical, absolutely, it's a tailwind for our business. And by the way, it really helped to upgrade a lot of the infrastructures that were so underinvested in for so long. And there's still a long way to go to make sure that we can make sure that the environment where our students are learning is safe and healthy.
Give me a perspective globally. So I know the majority of your revenue comes from the Americas, but do you see any signs of slowdown elsewhere? How do you think, and he's smiling at me, and I don't know why. How do you think about managing the trade tensions between the U.S. and China?
Yeah, I'll tell you, if I look at Europe, we'll start in Europe, okay? Europe for most was down in the first quarter. We were up, high single digits. Why? Because we led with our innovation there. We created systems that are fundamentally different than what was out there in the past. We've been able to change the way heating and cooling happens for a building. In a traditional building, you had a heating plant, we'll call that a boiler. You had a cooling plant, we'll call that a chiller, and they operated independently. What we were able to do is combine it into one system. So it starts with a heat pump, it uses sophisticated controls, it uses other parts of that system, but it basically can significantly reduce or eliminate the need for fossil fuel. And when you think about that from a carbon footprint, 15% of all greenhouse gas is from heating and cooling of a building. Well, a lot of that is from the heating because it's using combustion from fossil fuels. If you could eliminate or significantly reduce that fossil fuel, you now have a different solution. I always tell people we're the disruptor in our own business, but we created solutions that were fundamentally different, and we're winning with those solutions. In China, just to your question on China, our revenue growth in Asia was up, I think we're up 16% in the first quarter, so very strong, seeing a lot of demand across many verticals again. High tech is certainly very strong there, data centers, semiconductors, and I would also tell you that we have a great leadership team in China. Our team's been there they have a long tenure, and they also have what we've done was we took what we did in the U.S. and brought it to China probably about 10 years ago and built out a direct sales force. So we love being close to the customer. We love understand what their needs are, and that was a different model really in China.
All right, Dave, this is great stuff, and really appreciate you stopping by.
All right. Well, thank you very much for having me on your show.
Absolutely. Dave Regnery there. He's the chair and CEO over at Trane Technologies. All right, coming up here on the program, we're going to stick in the energy space, if you will. Take a look at shares of Plug Power surging today here. Really the confluence of both, of course, the green energy revolution and, of course, government subsidies as well. It is our stock of the hour, and it's up next right here on The Close on Bloomberg.
Season is here.
This is a get out the popcorn moment.
And across the board, just pummeling of expectations.
Earnings matter. That's really clear.
Bloomberg is first to break the numbers.
Hey, folks, we've got Microsoft.
Apple earnings crossing the wire.
Alphabet, wow, coming in way above expectations.
Hertz driving in the opposite direction.
A lot still to come.
With the smartest insights.
Meta's kind of damned if they do and damned if they don't.
Is this their iPhone moment? I view this as Operation Kick the Can to August.
Continuing coverage on Bloomberg. Context changes everything.
All right, time now for our stock of the hour. A closer look at Plug Power. The hydrogen producer seeing its shares soar today after the Biden administration gave a conditional commitment for a $1.7 billion in loan guarantees to build up 6 facilities. Abigail Doolittle joining us right now for what is our stock of the hour. And it's having a good day here. This is all because of this $1.7 billion loan deal?
It seems to be. I think that the folks, Andy Marsh, CEO, and the executive team up there in Latham are probably seeing a big relief here, given the fact that there was going concern risk just last November. So now they've received this cash. It is conditional. It goes toward the 6 plants. Apparently, it's going to really shore up a big plant in Texas that will be supposedly bigger than the other green plant that they have in Georgia. But I feel as though this company has so many different lives. I mean, if you look at the chart, the all-time high was back in 2000 on an adjusted basis. It was trading at like $1,500 at that point. So, kick the can down the road, extend it, pretend. The big question is whether or not, this green revolution has real legs.
And my first thought, too, just looking at the underperformance of this company and this stock was like, I thought of Solyndra immediately. And
what?
Solyndra, which was like the old loan program that they gave, what was that? I don't know how many moons ago that, of course, blew up in their face.
So the guy who's giving out the loans for the DOE is the same guy who also did Solyndra. And if you talk to him, he's like adamant that the qualifications and the stringent rules that they have are different. But remain to your previous point, Plug is one of the most crowded shorts, as all renewable stocks really are. So you could also make an argument that it's not going to take a lot of good news to get this stock to see some major short covering.
Absolutely. I 100% agree with you, Alex. And I actually meant to see how much the short interest grew since last November. Right now, it's 26%. And the fact that at the highs, the stock was up 70% really tells you that people thought that there was a chance that there was a true going concern risk. But now we have this move out. Again, they have basically a life to see whether or not it takes off. The big question is not whether or not green hydrogen is going to be produced. It's much more so whether or not it's actually going to be used. But we have had Rolls-Royce, EasyJet. They've both said that they can use it in their engines because, of course, if you use solar or wind power, that fuels electricity. But jets, steel manufacturers, and some other big, heavy load industries, they can't use electricity. So they need this kind of fuel. And in fact, CVX, Chevron, has a 78% stake in what's supposed to be the biggest hydrogen plant out in Utah. So I think it's too early to be seen, but at least a little bit of good news for a company here that was really under a big crunch.
But a lot of reasons why it was under that crunch, there was a lot of concerns as to whether the hydrogen was going to be viable as a renewable source in the same way that I guess, the battery technology and some of these other sources are.
Super expensive.
It's super expensive. And then there were a lot of issues, I think, with like portability and elsewhere. Has that been resolved, or is this still kind of the same?
I mean, I think that it's the same to a large part. The green, there's blue hydrogen, gray hydrogen, green hydrogen, and pink hydrogen. Pink would be my hydrogen personally, but green hydrogen.
Safe? Pink hydrogen?
Yeah, there is. I mean, it's really interesting. But in terms of the green, they basically break apart the water and the hydrogen using something called an electrolyzer. Apparently, it's hugely expensive. You need a whole new infrastructure. So I think that those same problems are there. But if they can really develop it, and a part of this is the scale. If they can build it out and scale, then there's a chance. Biden administration clearly wants that.
So the green part comes in how you power the electrolyzer. So when you do any sort of hydrogen movement, you're always using an electrolyzer. It's how you power it, and this is green in terms that it's powered by wind and solar. And the issue is actually, in terms of transporting it, you can still transport it through like a natural gas pipeline. There may be some adjustments, but overall, the idea is it should be relatively easy, but the problem is the offtakes and how to get that pricing together. So there might be the demand for sure, but it's what they're going to pay for it. And that way, I think, is the missing piece as of this moment.
Yeah, and I'm not even sure that we know about the demand yet. It's really...
No, you don't, because you can't price it.
Yeah, exactly, because the supply looks like it's going to be there, but that's exactly right. Will people pay up for it?
Right, and that's many seem to say that's what the IRA is missing, is that demand piece. All right, Abigail, thanks a lot. Super fun, obviously. I like it. Abigail Doolittle joining us there. Coming up, we continue to count you down to the closing bells with Mark Lucchini, Chief Investment Strategist over at Janney Montgomery Scott. This is The Close on Bloomberg.
This is the countdown to the close. Romaine Bostick alongside Alex Steele. 10 minutes until we get to those closing bells, and we got a decent rally in our hands. I was looking at the S&P, Alex, 52.46 right now and change. That's just a few points away from that all-time high.
Yeah, the volume's still a little light, though, for the S&P, but the NASDAQ seeing super nice volume, and part of that is the best-performing stock is Faraday Future Intelligent. Now, I've never heard of this stock, but I'm hearing that this is taking part of the meme stock craze alongside the GM, the GameStop, alongside AMC, et cetera. So we can't discount that. the same time.
Yeah, I mean, most of these are the meme stocks. Faraday, I don't know. Are they still making cars? I
don't know. It's up 352%.
to 28 cents here on the day. Meanwhile, the market continues to roar higher despite some economic data that was a little bit mixed earlier this morning. We had a chance to catch up with Maria Vassalou, who's the head of the Research Institute over at the Pictet Group. And we asked her whether she expected that data to support Fed rate cuts this year at all.
I don't really see a reason to cut. If anything, I would say that until recently, the monetary policy hasn't been particularly restrictive. It's only now that the U.S. consumer has worked through its savings, and we're seeing some tightness in the market. So the Fed has to thread the needle very carefully.
Maria Vassalou there, who helped us kick us off to the closing bells just about an hour ago. And here to help take us to those bells is Mark Lashini, Chief Investment Strategist over at Janney Montgomery Scott. Mark, great to have you here on the program. This seems to be that weird sort of phase of the economic data cycle where I don't know what to make of it. I mean, you can look at the PPI report and you can see good, you can see bad. You can look at the small business sentiment report, you can see good, you can see bad. What exactly are you seeing right now?
You're absolutely right, though, Romaine. I mean, it's very difficult to tease out exactly with any kind of conviction what we're actually seeing. I mean, obviously, besides this morning's PPI print, we've had several come out on CPI and, of course, the PCE, the Fed's favorite gauge, that would be indicative of stickier inflation. And obviously, we get a report on CPI tomorrow morning that will either affirm or deny whether or not that has been anomalous or in fact, more indicative of a pattern that is obviously going to keep the Fed's attention on keeping rates higher for longer. But nonetheless, I mean, overall, I think we're seeing a backdrop of pretty firm economic activity. The Atlanta Federal Reserve's GDP Now tracker showing 4.2% annualized growth here with the data that's come out in the second quarter. That builds on the pace in the first quarter. Certainly a lot of momentum suggesting that the expansion ought to continue. Right. The labor market remains pretty tight, albeit signs of it cooling. And so on balance, even the global backdrop is showing some percolating activity. So all in, I think it's a scenario that's pretty supportive of risk assets. And obviously that's certainly being reflected today.
We certainly are. I mean, we're just a few points away from another record high on the S&P 500 after basically about 6.5 weeks since the last one. And it gets to the question here about this sort of re-embrace of animal spirits. Not only is it going to be supported, Mark, by the economic data, but do you think the corporate fundamentals themselves, the next batch of earnings that we get for the second quarter, that's also going to give credence to this run-up in valuation?
Well, I think it really has to. Obviously, the valuation of the market suggests that investors are going to be increasingly demanding with regard to those expectations, given a forward multiple of about 20 times on the S&P 500. Having said that, so far with about 92% of S&P 500 companies, maybe a few more at this juncture, have reported earnings. Earnings are coming in at about a 5.2% pace year-over-year, quarter-over-quarter growth, and that is indicative of at least a continuation of the theme of 3 consecutive quarters now, positive year-over-year earnings gains, certainly better than what was expected coming to this quarter, but the comps get a little more difficult because the sequencing going forward is that those consensus estimates continue to rise in and through the end of this year and even out into 2025, which maybe to some degree the market's already pulling on given today's valuations. And so a lot of the heavy lifting from this point forward is going to be really residing on the back of those corporate earnings being delivered on those expectations rather than expecting more multiple expansion given where we sit today on a PE level.
Which, Mark, is just basically the expectation game, which leads me to then the tightness in financial conditions. Can these companies continue to return all these corporate profits and have these corporate profits if financial conditions are truly tightening? Are they? I mean, are they?
Well, you know, Alex, it's interesting, even in spite of the fact that the Federal Reserve has obviously done what it has done to raise interest rates. If you look at some measures of the financial conditions index by the Chicago Fed or even Bloomberg itself, you would argue that, in fact, conditions have been actually loosening to some degree and are far and away at a minimum far less tight than where they stood a year ago. So on balance, even considering the above, it looks as though the markets are breathing relatively easily. You look at the high yield spreads over treasuries. They're not necessarily at all-time tights, but eerily close to. And again, valuations for what investors are willing to pay for risk assets, certainly, again, not egregious, but hardly inexpensive, suggesting once again, there's not a lot of risk premium built into those measures that would indicate concerns about things being too tight that could thwart economic activity and pull us into a recession, at least in the imminent future.
Yeah, and you have to wonder too, right? Like, if you have the meme stock craze happening again,
yeah,
would you have financial conditions tight if that would happen?
Don't seem too tight to me.
That's what I'm saying. So, Mark, before I let you go, if there is a safety trade that you have or a safety play that you have based on sort of higher for longer and the circumstances we've laid out, what is it?
Well, really, obviously, cash is yielding an attractive interest rate today, and if it's higher for longer, it means it's going to continue, and you don't have to necessarily worry about the Federal Reserve taking your knees out from underneath your money market account yield anytime soon. The other, of course, has been gold and even copper, which are kind of interesting because it's somewhat bipolar that they would both be doing well in the same environment. Copper prices are up about 20% year to date. Gold almost 15%, but that I think is a part of the yin and yang and the fact that we're seeing some improvement in the international economic activity front. At the same time, though, central banks are easing, and central banks outside the United States are purchasing copious amounts of gold as they swap out treasuries for a hard asset they feel more comfortable collateralizing in their economies.
All right, great stuff, Mark. Going to have to leave it there. Mark Licini, Chief Investment Strategist over at Janney Montgomery Scott, helping us count you down to those closing bells. We're just about 2.5 minutes away here. An S&P 500 that at one point in the day, and frankly, quite about 3 minutes ago here in the day, came about 4 points away from a new all-time high, Alex.
So close. JP Morgan was saying that traders are positioned on CPI day for a move of either 1% up or down. So we could hit a new high tomorrow. We could hit a new high for tomorrow, and kind of a huge turnaround. I remember just a month ago, we were all pulling our hair out because the S&P was retesting that 100-day to the downside. What a difference a month makes. Stick with us. We're about to take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell. And here they'll take us beyond the bell. It's a global simulcast. Scarlet Fu joining us here in the TV studio. Carol Masser, all alone. Apparently, Tim Stenovic got fed up with her. So Carol is going to have to do all the heavy lifting today.
Nobody wanted to play with me today.
And he's missing out here, Carol. This is a pretty good day in the markets. We've been talking about the S&P flirting with another record high, but really just an overall embrace right now of risk assets, something that we hadn't really seen over the past couple of months.
Kind of interesting. I feel like the last hour and a half to see investors kind of coming in and bidding up this market on the equity side of things. I'm looking at something like the SOX, the semiconductor index, really some outperformance there, Scarlett, up 1.7%. Wells Fargo increasing its price target on NVIDIA today to $11.50 a share from $9.70. So giving some momentum certainly to that space today.
Yeah, but it's really a waiting game until tomorrow's CPI. And in the meantime, the big movers, again, come from those meme stocks, whether it's GameStop, whether it's AMC, whether it's anything else, Hertz, you name it.
Yeah, and that's why the NASDAQ is outperforming in terms of, well, actually the equity price and also in terms of volume, too. That's a meme stock story. And something I was bringing up with Mark Licini of Janney Montgomery Scott is if the meme mania is here again, can financial conditions actually be tight enough for the Fed to cut?
Also interesting, too, to see some of the big bids that we're seeing in a lot of, I guess, those sort of energy-related stocks. So we were talking about Plug Power a little bit earlier. Enphase getting a nice bid. You're seeing the EV stocks as well, and some of that, of course, being fueled right now by the latest news out of the Biden administration, increasing those tariffs and restrictions on imports of Chinese goods in the same space. Let's walk you through the numbers here as we get the closing bells on this Tuesday afternoon. With the Dow Jones Industrial Average posting up about 100 points higher than where it was yesterday. That's good enough for a gain of about 0.3%. Meanwhile, the S&P 500 is going to close right around that 52.46 for Mark. Remember, the all-time high was 52.54 and change set back in late March here. So really just a tick or two away from that tomorrow should this optimism hold. Up today, 0.5%. The NASDAQ composite up about 0.8% here on the day. And the outperformer was those smaller cap names as a lot of those meme meme stocks really sort of fueled a big rally there. The Russell 2000 up 1.2%.
All right, we do talk about the meme stocks a lot, but as you guys said at the top, Romaine, I think you said it, the risk on trade, we are definitely seeing it. I mean, you look at the S&P 500, most names, Scarlett, in the index higher today, 320 to the upside, 183 losing some ground, though.
Yeah, and I've been steadily tracking the industry group movers and how everything's moved towards the green. So that's why the big pie is mostly green. Tech, of course, the biggest sector in the S&P 500, up 0.9%, leading the advance. Supermicro is the outperformer there. REITs and financials also gaining at least 0.5%. On the downside, you've got industrials, little change, so it's a laggard, but staples and energy stocks finishing in the red.
All right. You know where I'm going to go for my gainers because I kind of have to. I'm looking at these meme stocks. So GameStop at its highs, up almost 113% today, finishing the day with about a 60% gain. That's after a 74% gain in yesterday's session. So we're talking about in the last 2 days up 180%. I mean, I got nothing.
Enough said on that one.
Let's just go to AMC because the same story, up almost 129% at its highs today, finishing the day with a gain of about 32%. So a little bit of a swing there, and that's on top of an almost 80% gain yesterday. So I don't know what that says. It shows the willingness of investors to play in this market and take some risk in a big way. So fascinating to see that. And here's one more logical, perhaps, on holding. Up at its highs, about 21%, finishing the day with about an 18% gain. Swiss sneaker maker, disclosure, I own them. I like them. Posted strong first quarter revenue. No, I own the sneakers.
Her and Tim, they're cool there.
Posted strong first quarter revenue, nudging its sales forecast higher for the year, boosted by demand for its running shoes and new line of training apparel. So again, up. I'm looking at quarterly sales up about 29% from a year ago, and that was ahead of market expectations. So investors pretty happy, guys.
So it was kind of hard to find some decliners, but I managed to find some. Let's go to the media space. We'll start with Paramount. It went from $13 and change to below $12 to $11.89 after CNBC reported that Sony and Apollo are rethinking their bid for Paramount. That's not to say that a deal can't happen.
Will somebody just do something on it?
I know.
So
that's what Sherry Redstone is thinking too. Will someone just do something, please? Apparently, Sony hasn't even signed an NDA, which means that they haven't really begun the due diligence on this. So you can see the stock, finishing down about 5.25%. Netflix, it had fallen as much as 1.3%. It ended up paring some of those losses, but it is still the biggest decline this month, losing about 0.5%. Comcast says it will offer a streaming bundle that includes the Peacock service, Apple TV Plus, and Netflix in order to reduce subscriber churn. No word on pricing. Notable only because it's another streamer that's not doing too well today. And let's end with CVS. The CFO says the company's Aetna insurance unit may lose up to 10% of Medicare members as it tries to boost profitability. How's it going to do that? Well, Aetna will reduce benefits for members, including popular offerings like over-the-counter health products, transportation assistance that had played a big role in attracting seniors to its private Medicare plans.
All right, well, here we go. We see that headline there. NASDAQ ends day at record high, but you're also seeing a bid into the bond market all across the curve, yields moving lower. Simon White is a macro strategist for Bloomberg, and he was saying that the more days when stocks and bonds are positively correlated versus when they're not increases the likelihood that, guess what, guys, bad news is good news, and that dynamic can continue to persist, at least in the near term, and you wonder if we're going to see that dynamic play out tomorrow, guys.
All right, so everything is awesome, everybody. No, it's really not. And I'm going to bring you to this story that is out here from the New York Fed. U.S. household debt has reached a record. More borrowers are struggling to keep up. Overall, U.S. household debt rose to $17.7 trillion. This was a report that they put out today. That's an increase of about $184 billion or 1.1% from the fourth quarter. Consumers adding, Scarlett, $3.4 trillion in debt since the pandemic, and that increased debt bears much higher interest rates, which we know becomes problematic.
Absolutely. You look at the charts for auto loans or credit cards, and it goes straight up and to the right. Certainly an issue here, especially for the lower income strata of Americans.
Yeah, the only thing is, I hate to sort of do this because I know everyone always says, oh, you have to look at the ratios and everything else. But in that same report, they kind of just basically said, too, that a lot of these numbers are just going back up to kind of what they were pre-pandemic before all that, government stimulus came in and gave everyone that cushion. Now, I don't know if that's a good thing or a bad thing, but at least it's not like, I guess, some extreme level.
But then you also take a look at, say, the NFIB, which surprised to the upside today in a good way, right? So maybe, and that was a worry for the last few months. So maybe some of the cracks maybe we be dissipating a little bit on that end. But
and one thing that I thought was interesting in that NFIB report too was the part of the survey where they basically said they don't plan on raising prices, those small businesses. So I mean that should be welcome news to consumers and I guess to the Fed as well.
Yeah, but is anybody cutting prices?
No.
I don't know.
If you know of a place, let me know. Well, it's funny you say that. I'm curious. Have you? I mean, I don't know how much you shop, but have you seen like any significant?
No, I don't
discounts?
shop. People just bring me things. That's how it works in my life.
gosh,
No,
here
of
we
course
go.
I shop. Of course I shop. So, what's your question? Go ahead.
You missed it. I moved on. Now, do you watch TV, Carol Massar?
I watch a fair amount of TV.
All right.
I
There's
know where
another
you're going
story
with
that I've
this.
been keeping an eye on.
I actually watch what you're going to go to.
Okay. Can I go there?
Yeah, go.
Okay. Thanks. So one thing is basically 10% of us are just watching YouTube now. How about that? Basically, I thought this was interesting. I mean, it's kind of what we know, right? Is that so much of our viewing habits have shifted to these streaming services, but it's not necessarily the Netflixes and the Paramounts of the world. It's actually YouTube. And I don't know about you, Scarlett. You have I think kids around my age. I mean, my son, he only watches YouTube. I mean, he doesn't watch anything else.
You know, I have a theory, which is that all seniors and babies, or maybe young children, watch YouTube. Like, they're driving the adoption of YouTube. My parents, who are elderly, they just watch YouTube nonstop at very high volumes, by the way, but like nonstop.
Can I just say, all right, for you, like I have a husband who likes planes, and so he subscribes to very specific niche channels that are like pilots and so on and so forth. I sail, and so we like subscribe to all of these channels of people who are sailing around the world. It's very niche programming, and like you think about really drilling down in terms of topics. That's a lot of what it is. It's kind of interesting and engaging.
Remember
it's
we
not
were
just
talking
for
about
old
the
people and
hydraulic
babies.
presses and the Apple commercial?
It's not.
There's a hydraulic press channel on YouTube.
So here's the thing, though, is that we're going to go this whole way I've been celebrating YouTube, and yes, they got 10% for Nielsen ratings, but you know what got 11.5%? Disney Plus. So we're not like kick that habit. I mean, it's still a Marvel Star Wars world, let's be honest.
And Simpsons.
And Bluey.
Wasn't there a story about somebody bundling today, too? About a bunch
Yes.
of, right? We're going back to bundling in the streaming services. We're going there, Romaine. We're going there.
I thought the cable companies were over. What's happening?
Everything old is new again. Old people
Actually, I
and
shouldn't
babies,
say that.
Scarlett.
We love the
Old
cable
people and
companies,
babies.
by the way.
YouTube.
Blah, blah, blah.
All right. That is a wrap. Our cross-platform. See what Tim missed? He missed a lot today. All right. That's a wrap. Our cross-platform on radio, TV, YouTube, and Bloomberg Originals.
Oh, we are on YouTube.
Yeah, we really are.
Wow.
That's what led the rating increase, guys.
Beyond the Bell. We'll see you same time, same place tomorrow.
All right, a lot more coverage coming up here on Bloomberg Television. The meme stock rally that went into overdrive yesterday still had a lot left in the tank today here. You're looking at the after hours trade right now, but that really doesn't really capture the whole story. GameStop, AMC, Faraday Futures, all of your favorites posting double-digit percentage gains on the day. A conversation coming up after the break on The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Quite another wild day in markets, 52.54. That's the number I want you to keep in your head, Scarlett Fu, because that was the record high for the S&P 500 back on March 28th. It's been 6.5 weeks or so since it even came close to that level, but it came close to it today. The close today at 52.46 and change, and we should point out it did trade above that 52.50 level. Quite a turnaround from really just 4 weeks ago when the S&P had dropped below that 20-day, dropped below the 50-day, and dropped below the 100-day, and everybody thought the next step down was even lower. That is a big turnaround, a re-embrace of risk assets. You see that in the Philadelphia Semiconductor Index. You see that coming into the bid. And, well, a lot of the solar stocks, and some of that is less to do with animal spirits, Scarlett, and a lot more to do, of course, with those, I guess you call them subsidies, if you will, or tariffs that the Biden administration is putting in place to protect U.S. industries.
Protectionist measures, however you want to put it, right?
Yeah.
Okay, let's take a look at some of the day's big movers here. We're going to start with On Holding. This is the Swiss sneaker maker that's backed by Roger Federer, climbing more than 18% on the day after raising its full-year sales forecast. One analyst says that the higher guidance is actually due to favorable currency swings. So there's actually room for the company to raise its guidance even further, maybe later this year. On the flip side, Paramount Global, this is the streaming company. They own Viacom, they own CBS, Showtime, down 5% on the day, tumbling at midday after CNBC reported that Sony and Apollo are rethinking their bid for Paramount. That's not to say that a deal can't happen, but they haven't gotten very far. The discussions haven't reached a point where they're actually doing due diligence, and Sony has signed an NDA. The other thing to note as well is that Comcast said that it is bundling its streaming service, its Peacock streaming service, with Netflix and Apple TV+. So that might be another source of pressure on Paramount. Our top story this hour, Goldman's view on credit risk. Bloomberg sat down this week with top executives from the firm. CEO David Solomon told us that he sees an uptick in deal making, while global head of asset and wealth management Marc Nachmann shared plans to build up an Asian private credit business. Well, now it is President John Waldron's turn to discuss high yield and leveraged finance markets. Romain?
All right, let's move on to the business of sports, Scarlett. One of the most talked about leagues kicks off its regular season tonight, and it is, of course, the WNBA. New and old fans have been enticed by the three-point shooting skills of Sabrina Ionescu, the prowess of reigning champion A'ja Wilson, and, of course, the Caitlin Clark effect. The league is expanding. The resurgence in popularity fueling expansion to new cities, and today, the Golden State Warriors out there in California unveiled the name and branding of its franchise team, the Valkyries. Joining us right now with more on this expansion is the president of WNBA Golden State, Jess Smith. Jess, great to have you here on the program.
Thanks for having me. Big day.
It's hard to sort of understate or overstate the excitement out there right now for women's basketball. And this really, we should point out, kind of predates even Caitlin Clark kind of coming onto the scene. That's going to change things in a big way later tonight when they tip off. But talk a little bit about your team. I know you still got to wait another, year and a half or whatever before they actually take the court here. But you've got to be pretty excited right now.
We're incredibly excited.
Yeah.
You know, this moment to share who we are as a brand. We have 1 year, right, until we're entering this league on the court. But we're now representing our fan base. We are building a culture that we can invite people into. And for us, we have to represent the Bay as well. You know, the Bay is an incredible sports culture, but more importantly, it's also a culture that is innovative and progressive, you know, and draws people in, you know, to move this world forward. So for us, we really like to focus on, you know, we make the impossible possible, you know, through this. So we look forward to our fan base being a big piece of that.
So you have a lot of work to do over the next year and a half. When it comes down to it, when you actually launch, what specific metrics would you rely on to determine whether you have a successful debut season? I imagine it's a mix of season ticket sales, sponsorships, and merchandise sales.
It is. You're exactly right. So those are the three components to revenue. For us, we're measuring two things before we get to opening day. User acquisition or fan acquisition, right? It's our job to build that trust, to build people into our funnel, whether they're a casual fan or an avid fan. And then, you know, to your point, how do we make them a buyer? How do we earn that trust for them to convert into season tickets, merchandise, and then certainly work with brands to have those incredible partnerships that define both of our brands together?
You mentioned casual fan, you mentioned diehard fan. How do you measure buzz or just zeitgeist? Because other things like sponsorships and season ticket sales, there are numbers attached to that, but buzz doesn't have a number attached to it.
Yes and no. There's earned media, right? And so there is measurements to people talking about you. I think the thing that's immeasurable is women's sports in totality right now, right? There's an emotion behind what is being driven right now that we can't ignore. It's actually leading to revenue at the same time. Specific to sponsorship, you know, the valuations for so long were just compared to exactly how men were selling this. And there's a different value for women, you know, because when you sponsor a women's sports team, a women's league, a female athlete right now, you're showing the world that you believe in the progression of women's sports. And that means something from a value standpoint and a brand loyalty standpoint.
I'm glad you brought that up, too. I thought it was interesting. Amid all these announcements, you also are going to be using the Warriors' old practice facility, right? Which is actually a pretty nice place.
Yeah.
But there has been a lot of talk here about obviously the disparities in the facilities that the women players have in the WNBA versus the men NBA here. Why was it important to sort of improve or at least have a better facility for these folks?
Infrastructure is something that is being focused on across all sports for women right now. And it's a big component, right? We expect these athletes to be elite and we want to make sure that they have that place to train their bodies, recover, and so forth. So us having that space in Oakland, you know, the fun part now that our brand is here here, we're going to make it our own. You're not going to be able to walk in there and not feel like you're part of the Valkyries. And we're also going to be making some changes to make sure that that facility is more geared towards women. What does, the bathroom and locker room facility feel like, to make sure it's theirs as well.
And that's important too. I can't remember who the player was, but I remember during the NCAA championships, someone made a comment about the facilities that the women had, weight room facilities, I should say, versus what the men had, and basically said it was literally like a kettlebell and a bouncy ball.
Yeah, a few years ago.
And everything else. But it kind of gets to this idea of the ambition too, right? So you're the owner of the team. Talked a lot about how he's going to win a championship in 5 years. I won't put that much pressure on you. But he also talked about the idea of the type of revenue he wants to generate and things like that. So these are pretty lofty goals, and not the kind of goals that we heard, I feel like, maybe 5 or 6 years ago from some of the owners.
But that relentless, appetite for success is what's going to drive women's sports forward. When you think through pay equity, the formula to get there is to actually drive more business and revenue. And what we're seeing now is the equation of that whole ecosystem working together, right? You have media, doing their part in this. You have partners doing their part in this. But most importantly, you have fans. Fans are demanding this, and everyone else is responding and yet being rewarded for it. They're showing up, they're buying tickets, they're buying merch, they're talking about it on social media. They're telling everybody what they need to earn their trust. And that's really what's going to progress this forward to get to that pay equity piece. So, our ownership group certainly has lofty goals, but candidly, I think they're incredibly achievable. And we hope to do that and then make sure that others can do that right beside us.
Jess, I look at your bio, and one of your areas of expertise is sponsorships, with the Oakland A's, certainly in baseball, with the San Jose Earthquakes in Major League Soccer, and with the Angel City Football Club in the NWSL. What is the single biggest difference between sponsorship across these different sports?
It's really about each sport has its own fan. And for so long, especially when you're looking at men's and women's sports, whether it's basketball or soccer, often people just assumed NBA fans are WNBA fans and MLS fans are NWSL fans. And there is certainly some crossover and an opportunity for a great crossover, but it's a unique audience. The product is totally different. For so long, people approached it as, well, people went to an NBA game, but they don't want to come to a WNBA game. And yet the product itself is this mix of sport and purpose and pop culture. So you have to build the product first, before you go out and get the partnerships to come beside you. And for us, we're really seeing a lot of new consumers come into sport for the first time through women's sports, because it means something deeper than simply just going to watch a game. Of course, once they're there, then they're in, right? And then you're cheering for the win like anybody else. For sure, absolutely.
Jess Smith, really, really great to meet you, and good luck over the next year and a half. Jess Smith is president of the brand new Golden State Valkyries. All right, let's get more analysis on the business of professional basketball with Bloomberg News U.S. sports reporter Randall Williams. And Randall, one of the biggest topics in sports, of course, is media rights. And the NBA is right now in the middle of finalizing who's going to carry their games. What's the latest here? Because the exclusive period that the NBA was negotiating with current partners had expired, and so now it's wide open.
So Bloomberg's Lucas Shaw reported that basically ESPN and Amazon have handshake agreements with the NBA. They're not final just yet, and I think that's because of the fact that NBC and TNT are still in the midst of the bidding war for who's going to be this final partner. So that's yet to be determined, but as it relates to the WNBA, they're getting ready to triple or double their package as well.
I'm curious, though. We talk about this idea where this contract goes. There has been a lot of discussion, at least among fans,
for sure,
about how spread out the games are in terms of across different channels and platforms here. Do you think we're going to end up at the end of this contract negotiation with sort of a single channel that we all go to, or is it all going to still be fragmented?
I think it's going to be. It's looking like three partners right now, based on what's been said as far as how, if you're looking at TNT versus NBC, it's not like they're bidding individually. It sounds like they're bidding against each other based on all the reports that are out there.
Yeah.
So it sounds like it'll be ESPN, Amazon, and whoever else gets that last slot.
When we talk about the NBA, Adam Silver is always cited as the most innovative sports commissioner. What is it that he does that's kind of light years ahead of his peers? Why is he kind of setting the tone for all the other sports leagues?
I think he listens to players more. Quite frankly, I think he has an open relationship. He doesn't really shut down anything. If you think about the way that he handles not only media negotiations, but think about the Ja Morant thing. People were saying, Ja Morant was suspended for far less games than he should have been, and then he had another conversation before the second iteration of that suspension came about. The exact same thing with Draymond Green. And so I think he listens to players. I think that he approaches business with an open mind, and there isn't anything that he's going to say no to. He's trying to keep the audience young and also bring in new fans. And so when it comes to that, I think he's very good at that in particular.
I want to make a quick pivot here. We only got about a minute left.
Sure.
But you had a story on the NFL, on football here, and this was about ownership stakes and the ability of owners now, or potentially to sell up to 30% of their team to private equity firms.
Yes, sir. Yeah, and so basically a private equity firm will be able to come in and purchase 10% of a franchise. Now, the teams themselves can sell 30%, meaning that 3 private equity firms can each purchase 10% slots each. Now, there's a couple different franchise stakes that are out there right now, a 25% stake, I believe in the Bills, a 24% stake in the Chargers. I don't know if they're going to be that large in the future, but we'll have to see.
Well, why did we need permission for this? Forgive me if that's a dumb question. Why was this not allowed prior to this?
Well, the league has some of the most stringent ownership rules out there, and I think if there's no need for it as far as what the owners feel like, then they won't do it. Yeah. But now with taxes going up, with some of the things, these estate taxes going up, and when you're trying to build stadiums and you're trying to bring in more capital, sometimes these owners can't front the bill for every single stadium or every single project that they'd like to have. And so private equity can come in, sell 5 to 10% of a team, and maybe that's $300 to $600 million, and you can help get whatever project you're trying to do across the finish line.
Yeah, the family owners may not be liquid, but those PE firms certainly are.
Exactly.
All right. Bloomberg's Randall Williams, thank you so much, covering the business of sports. Coming up on the close, meme stocks continue their rally. We're going to break down the latest price action with our very own Bailey Lipschultz next. This is The Close on Bloomberg.
All right, one of the biggest gainers in after-hours trading is GameStop, up 11%, AMC up 9%, and that doesn't even take into account what we saw during the cash session, a 60% jump for GameStop. Bailey Lipschultz joining us right now on the new meme stock frenzy. This is insane, Bailey. I mean, we had, I forgot what the move was yesterday in GameStop. We get another 60% today. You got AMC, Faraday, SunPower, a bunch of other companies I'm forgetting, all also rallying on the top of this.
Everything's ripping. It all goes back to that first post from the Roaring Kitty handle on X, but it really does seem like that was just the spark that the market needed, because now, as you mentioned, we're seeing a number of heavily shorted companies that I don't think would classify as a quote-unquote meme stock that the retail crowd is buying to stick it to the shorts. It just seems like Wall Street is maybe putting their thumb on the scale where they can with some of these names.
Okay, let's go through what he actually posted, because it was a picture of a guy playing a video game, kind of leaning back in his chair, and then the next one he kind of leans forward, or it's the same picture. I don't know what that means, but he's also posted other things that is encouraging all this frenzy. Just decipher this for us a bit.
So in the meme-averse, outside of meme stocks, that's like if you're playing a video game, you're slouched back, you're not locked in, that's him engaging, or at least someone engaging in playing the video game. So being more attentive to it, maybe game on, going back to some of the craze around 2021. But we've seen a number of videos and montages, Wolverine and Peaky Blinders, you name it, that seemingly has no affiliation with anything. And to be open, he's never said anything. He's never mentioned any of the names or any of the tickers.
Well, that's what I'm curious. I mean, what drives this further? Because last time you had him making the case for why GameStop was a good stock. You had high short interest that provided a squeeze. That doesn't appear to be here right now. We haven't heard from Roaring Kitty other than this, cryptic tweak in that on the little video that he posted.
No one's seen Keith Gill. No one has seen him physically. He's not on his YouTube page. He's not on Discord. This is all coming from the X profile posting.
Do we know that it's him? Bailey, stand by. We have to take a break. Bailey Lipschultz here on the biggest story of the year, the meme stock frenzy. We'll be back in a moment. This is Bloomberg. All right, welcome back. We want to go down to the Goldman Sachs Leveraged Finance Conference, where Sonali Basak is sitting down right now with the president and COO of Goldman Sachs, John Waldron. Sonali.
Thank you, Romaine. And as you said, I'm sitting here with Goldman's president and chief operating officer, John Waldron, at a conference where almost a decade ago, you helped start in the world of leveraged finance. You and David Solomon had cut your teeth in this industry. And it's a good time to ask, what's changed the most about this business?
Well, first of all, it's great to be here back at this conference in California. We've been 9 years now doing this conference. We have about 80 issuers. and about 450 investors. So it's a great convening to bring the issuing side together with the investing side. I would say the answer to your question is undoubtedly the growth in private credit. So back 9 or 10 years ago, it was mostly a syndicated market. Private credit is not a new industry. It's been going on for quite a long time. But if you think about the size of the private credit market versus the syndicated market, the private credit market has grown enormously. And that's definitely been the biggest change in the structure of the marketplace.
Goldman has its own plans. There are large plans. You've told investors recently that you plan to grow your private credit business into a $300 billion business by assets in the next 5 years. How important is scale to you, and where is this on your list of priorities?
It's very important. I'm here for a reason. This is an incredibly important client franchise for us, and it's an incredibly important set of constituencies to Goldman Sachs. Private credit is a big growth opportunity for the firm. We have been doing private credit for a long time. Goldman Sachs has an over 30-year history of operating in the private markets, private equity, private credit, real estate, infrastructure, and other elements of the private markets. The big opportunity for us is to take what we've built, which is over $100 billion of AUM in private credit, and really double and triple it. We've obviously got to double it before we can triple it. So we've talked about $300 billion as a target. We've got to get to $200 billion first. We see a line of sight to doing that. But at the same time, I want to say that our syndicated business is a really important business. Leveraged finance is a long-term core strength of the firm. We've built a great business. We're number 1 or number 2 in all the major elements of leveraged finance, whether it's on the bank loan side or on the high yield side. We intend to continue to be there, and it's an incredibly important franchise. We are unique because we have scale in both. We can play in the syndicated market, we can play in the private credit market, and what our people know to be true is that their job is to go see our clients and give them good advice. Which market should you be accessing at which point in the cycle based on pricing, terms, availability of capital? And that's what we're doing. We're doing that, I think, very effectively. And I think we're uniquely positioned to be able to access both markets and be effective for our clients in that manner.
One thing that cannot be true is that of the billions of dollars flowing into private credit, everybody is an amazing underwriter. If you think through this market right now, where is the risk? And are people making mistakes?
Well, I don't know that there's clear risk in front of us. I think the explosion of credit broadly has been good for the economy. It's giving more companies and issuers access to more credit. I think there definitely has been disintermediation of parts of the banking system, probably more pronounced in the regional banking system than in the larger scale banking system. I think that's something that the regulatory apparatus should be paying attention to. But fundamentally, I'm not sure that there's lots of mistakes being made. I think that at some point we will have a credit cycle. When we have a credit cycle, my guess is there'll be some dispersion in the performance of different players in private credit. For us, we've been doing this a long time. We care a lot about structure. We care a lot about terms. We care a lot about underwriting standards, and we intend to be a good performer through the cycle.
You kind of have to have a crystal ball heading into that cycle, don't you? I'm wondering when you think that cycle will come and what it looks like when it starts to turn south.
Well, it's very dependent upon economic growth. You know, if we have a 2+% GDP performance in the U.S. economy or in the global economy for the next few years, we won't have a credit cycle. At some point, we're likely to see a contraction in the economy or at least a significant slowing in the economy. When that happens, that will be likely a trigger for more defaults, more challenges in the credit market, and we'll be prepared for that.
Now, another thing that a lot of people are waiting for is the revival of an M&A market to fuel this leveraged finance market that you've been talking about here. One of your top bankers just earlier was talking to a group of people saying that this could be a $4 trillion market or more again by the end of next year. Do you see that, and how fast can we get there?
We're definitely optimistic about the merger market. I think that we need the private equity community to be more active. We need the debt markets to be very open and available, whether it's on the private credit side or on the syndicated side. That's starting to happen. So the conditions are there for a much better M&A market. But the way I think about the M&A market, you've got regular way kind of corporate transaction flow. You've got very big deals. And then you've got kind of a broad private equity driven marketplace, which has been the biggest grower in the merger market. The regular way activity is pretty solid. The private equity activity is getting untracked, but it's not anywhere near what it can be, which I think is probably what our colleague was referring to. And the big deal market is kind of sluggish. Antitrust is tougher. It's not the best environment to go try to do transformational transactions. So if you got the big deal market firing and the private equity market firing, we could have a much bigger merger market. We expect both of those to happen, but I think everybody's kind of in a rush for it to happen sooner. These things take a while to unfold, and I would just caution that I don't think you're going to see tons of new activity in the next couple weeks or months. I think it's going to take us a little bit of time to get going, and very much dependent upon economic growth. So if we have strong GDP for the next couple of years, you're going to see the merger market start to really grow. It is clearly underrepresented as a percentage of equity market cap. That's a metric that we look at. I think it's 3 or 3.5% of total equity market cap. Really ought to be 5 or 6% of equity market cap. So there's a lot of room to run here, which could and should likely be the case over the next couple of years.
There's a real sense here that you and the bankers at Goldman Sachs are trying to put the M&A train back on the rails in a significant manner. But is there anything that could really hit pause on that trajectory? What are the risks?
It's not off the rails. We're having a very good M&A year this year. It's just not as good as it was when we had the kind of euphoria in 2021. But by any historical standard, this is a pretty good environment. I think we're 15% below. The market volumes are like 15% below 5-year averages. So we're not at 5-year averages, but we're not that far below 5-year averages. And it doesn't take a lot for it to really start to turn on. The deterrent to that would be economic contraction. It's very reliant on CEO confidence and GDP growth. I would say the two main factors driving the upswing and the M&A cycle.
What about the election cycle? We were talking to David Kostin, your chief equity strategist, a little bit earlier in the United States, and we were talking about volatility around the election. What does that conversation look like with clients?
I think clients are starting to pay attention to the election about now. For the most part of the year, it hasn't really been a major factor. It gets written a lot about, but I wouldn't say in decision making we've seen a lot of impact yet. But I think we're starting to get to a place where policy differential and the outcome is starting to become more part of the narrative and part of the discussion and meetings that we're in, and I'm sure others are in. And so I think we're going to go through the summer. We're going to have more conversations. As we get into the fall, I think it's going to become much more prominent in everybody's mind.
Are there specific policies investors are talking about with you, particularly when it pertains to either Trump 2.0 or Biden 2.0?
I think taxation, regulation, I think policy on China, those are probably major areas of focus. There are other important areas of focus that might not be as much economic, whether it's social issues or immigration or other issues that are important. But I think if you're talking about the things that really speak to the economy, it's global trade, it's regulation, it's taxation.
On China in particular, you had President Biden announcing more tariffs and China vowing resolute measures in return. You've spent a lot of time in China yourself. How are investors thinking about this dynamic of more tariffs?
Well, it's not surprising to me that the Biden administration is deploying tariffs. They obviously kept the tariffs in place that the Trump administration put forward and are now, kind of raising the ante a little bit. It's not surprising. I think that U.S. policy, frankly, from both sides of the aisle, is turning much more hawkish and is of the opinion that we have to protect and safeguard American interests and also invest in the industries that we need to be globally competitive in. And so I think you're going to see more of that. Frankly, whichever president we have in the next election, and I think that's a reasonable place for the U.S. to be, is to continue to invest to be globally competitive, continue to focus on our own competitiveness and investing in our industries. I also would say, and I saw Secretary Yellen's comments, which I think were good comments about continued engagement. We don't want to. I hope we don't have a zero-sum game here where it's kind of tariffs on tariffs. Hopefully we can continue to have a rational approach from both sides, and I think that this administration deserves a lot of credit, in my opinion, for having constructive engagement and putting the relationship in a firmer, on a firmer footing and having more dialogue, which I think is going to be important. We're not going to agree on a lot of these areas, but it's going to be important that we continue to engage with each other.
As you think about future administrations, also, you and David Solomon, your CEO, both have been quite critical when it comes to the U.S. debt load and what it means for the United States moving forward. Under both administrations, there's a sense from investors that fiscal responsibility will not be reined in. Paint a picture of what the world for the United States looks like if this continues.
I think the points that we're trying to make and that we discuss a lot inside the four walls of Goldman Sachs are we can't be complacent about continuing to spend at this pace and assume because we enjoy the reserve currency status that will always be the case and that there's not any risk to that. So I think we're looking for both parties to find a way to create more discipline in the fiscal spend. It's not that we shouldn't be spending. The country needs to be spending. There are certainly areas where we need to be stimulative from a fiscal standpoint. But broadly speaking, we think the pace is unsustainable. You're really now reliant heavily on U.S. households to continue to fund the Treasury spend. which I think is a perfectly okay assumption, but it's not an infinite assumption, and it needs to be thought about. And I think that we need both sides of the aisle to come together and be more disciplined in the spend.
At the same time, Treasury issuance has been significant, and there are a lot of worries about, as you say, who absorbs all of that issuance. We haven't seen any real hiccups yet, but do you worry that we will at some point if we continue at this pace of issuance?
We haven't seen hiccups. There's no evidence yet to suggest that we can't keep going in this direction. But I think those of us that have been watching this for a long time are worried that this is an unsustainable pace and that we need to show more discipline in the system. And I think the U.S. continues to be a great place to invest. There's a lot of demand for U.S. assets, including for U.S. Treasuries. But we have to make sure that we show the right kind of discipline fiscally and financially so that those investors want to continue to put money here.
John, we're hours away from another inflation print. And there are a lot of worries about what inflation means for the economy and the trajectory of interest rates. How are you thinking about it?
I think that we are continuing to be fairly constructive on what's happening. You have to give the Fed a lot of credit for engineering what appears at this moment to be a soft landing. We're not calling it quite yet. I think we have a lot of debate inside the four walls of our firm about where the direction of the economy will go. But it looks to us like the soft landing is very likely. And the Fed deserves credit for bringing inflation down and engineering, a reasonably good economic outcome. We'll see what the CPI print brings. Anytime you try to do what they're doing, which is an extraordinary amount of stimulus and then a really heavy amount of tightening in a short period of time, there's going to be bumpy outcomes. And I think we're seeing it's not a straight line down. There's been lots of disinflation, but inflation is proving a little sticky here as we're getting closer to trying to get to the 2% target. We expect that to continue to be the case. The PPI number, I think, showed that that's continuing to be the case. We'll see what the CPI number brings. I think our estimate is for 28 basis points. And the market's estimate is 30 basis points, so we're in and around consensus. And we'll see what it brings. But I think you're going to continue to see bumpy prints along the way.
Now, before I let you go, also, I want to talk about Goldman Sachs for a moment here because we're almost halfway into the year. You were one of the earlier banks to cut headcount when things got rough, and activity is now coming back across the industry. What does this mean for headcount moving forward?
We're continuing to invest in our firm. I'd say most of the investment we're making is in the infrastructure of our firm. We're continuing to try to find ways to create the infrastructure that we can scale against, and so we're going to make more investments there. And we're investing in our asset and wealth management franchise most prominently. So we want to build a much bigger asset and wealth management business. We're investing in our wealth management franchise, which is really more in people, advisors, support for advisors, technology around the advisors to make sure we can continue to grow our business there and to serve our clients more effectively. We think that generational transfer of wealth will need and require a lot more technology, and so we want to meet our clients where they want to be met, which is really in a more mobile world. And we continue to invest heavily in technology across the firm. I think generative AI will be a big unlock for firms in our industry, and we're going to be no different. So I think you're going to see over the next handful of years a much bigger spend in terms of looking for ways to deploy generative AI, particularly around automation and resiliency and doing things that are more maybe clerical and lower level activities that are more human process that can be uplifted into more automated technology-driven, AI-led activities.
It's clear that you're putting that spend across different areas of the business. Does this mean the hiring sign is up at Goldman Sachs today?
I wouldn't say that. I'd say that you're going to see us grow our headcount in a measured way. We obviously made the moves you talked about, 18 months or so ago. We saw a need to reduce our headcount from where we were coming out of the pandemic. I don't think that's very different from many companies that I certainly talk to and others talk to. Now at this point, I think we're in a place where we've created a good base. We've got places we want to invest, as I said, wealth management, asset management, technology, infrastructure. You'll see us add headcount at a measured pace in doing that, but it'll be at a measured pace.
John, we thank you so much for your time. That is Goldman Sachs President and Chief Operating Officer, John Waldron. Romaine, back to you.
All right, pick it up from here. Thank you so much, Sonali Basak at Goldman's Leveraged Finance Conference out in California. Taking a look at how markets fared on this day, we had some long-anticipated data. PPI, it was fairly mixed in that on the face of it, it was hotter than expected, but the previous month was revised lower. No one's really running off to the races with any conclusions until we get CPI tomorrow. The S&P 500 got close to matching a record high, but didn't quite get there. Either way, up about 5.7% since late April. Two-year yield comes down, dollar moving slightly lower, and GameStop, another day of monster volume, Romaine. Roaring Kitty. chalk it up to him.
Yeah, I want to hear about roaring Bill Gross. Did you see this story? He's selling calls into this rally. Basically, I guess he thinks it's over. Basically, the Bloomberg story saying he sold calls on GameStop and AMC. So we'll see what happens tomorrow.
All right, this is the close.
The first quarter in the United States was notable for its lack of further progress on inflation. We had higher readings in the first quarter and higher than we expected. We did not expect this to be a smooth road, but these were higher than I think anybody expected. And so what that has told us is that we'll need to be patient and let restrictive policy do its work.
All right, that patience may be being tested. Fed Chair Jerome Powell speaking earlier about the lack of progress on lowering inflation. We got the producer prices earlier today, and tomorrow we're going to get the consumer price index for April. Sarah Wolf, U.S. economist at Morgan Stanley, joining us now to talk about what she expects here. I was going through just some of the numbers on the Bloomberg terminal, our survey of economists here. I mean, it looks like it's going to be a pretty in-line type of number, basically where the trend line that we've been seeing, that's going to continue here. But is there any cause for worry that that whole disinflationary cycle that we spent so many months talking about, has that really been interrupted?
I don't think it's been interrupted. And I think that, the fault perhaps of markets is the recency bias and extrapolating forward the strength of the first quarter inflation data into the rest of the year. And I think that the risks of being surprised to the downside on inflation in the coming months are just as great as being surprised to the upside. And that's underappreciated. And all the indicators, the leading indicators for core goods inflation, for shelter inflation, for medical prices, financial services are all pointing towards downward pressure.
And were all those the things that were kind of the sticky things, so to speak?
The sticky things were really the core services component. So medical services, education services, motor vehicle insurance, of course, and then shelter is really that big component. Yeah. And shelter inflation is going to take a little bit longer to really start falling. But if we look at our forecast over the summer, when you build in new rent renewals, there is going to be a faster pace of shelter inflation falling this summer.
Those shelter numbers are pretty lagged, right?
Very lagged, 6 to 12 months. So we have quite a high degree of confidence that shelter inflation is going to be coming down quite a bit.
Yeah.
What about California's increase of its minimum wage law for fast food workers? I mean, Sweetgreen, for instance, raised prices back in February in anticipation of this law. So how much can you really gauge from the effect on food prices, for instance?
So it's really interesting. What we're seeing is that you have grocery prices, so getting food, eating at home, and then you have dining out. And what happened over the last couple of years is that grocery prices were so expensive, but dining out really wasn't. They weren't passing through all of that input cost and higher labor costs onto their final prices. So you start to see that shift, right? People were eating out a lot, and the divergence between dining out prices and grocery prices was quite narrow. Typically, dining out's a lot more expensive than going to the grocery store and making food at home. Now, what we're seeing is that grocery prices have come down quite a lot. They're basically running at a normal year-over-year run rate, whereas dining out prices are a lot stickier, and it's because of that labor input, which is a big part of dining out. And we know wage inflation is coming down, but it's still sticky and elevated. And there's more difficulties hiring for that sector. And so people are shifting away from dining out and going more towards grocery.
Or perhaps not hiring, as the case may be, and looking to just make do with fewer people or even automating the work that they do at a Sweetgreen or anywhere else.
Do I still have to tip, though, if I'm doing the
Well, they're going to ask regardless.
Okay.
How about that?
Just asking for a friend.
It's always there on the software. How did today's PPI report, which was fairly mixed, the headline numbers were hotter than expected, but you look at the granular numbers and it's kind of like, oh, well, maybe not as bad. And certainly the previous months were revised lower. How does that color expectations for tomorrow's CPI report?
So there's three components we care about in PPI that flows into PCE inflation. and it accounts for about a third of PC inflation. And remember, the bigger chunk, the other 2/3 that goes into PC inflation, the Fed's preferred metric, comes tomorrow with CPI. So we care about certain components of motor vehicle, medical services, financial services, and airfares. And what ended up happening is that it was a bit of a mix. It wasn't really that bad as what the headline PPI numbers looked like. Medical prices were up a bit, but not very much. Airfares were down significantly, and it pretty much offset the upside surprise in financial services. And so we're going into tomorrow tracking core PC inflation for the month, 0.24%. So that is a nice step down from last month. And core services are cooling down. And we do think that is in line with the type of data the Fed wants to see and continue to see to cut in September.
All right. There's another report, though, coming out tomorrow, and that's on retail sales.
Yeah.
We'll get a better read, maybe, on the health of the consumer. I was looking at some of the numbers on the Bloomberg terminal once again, and that shows a significant drop from what we saw in the previous month. So now, is that something that we should be concerned about, or is that just kind of the seasonal ebb and flow?
Monthly volatility, and so it's important to break out what we're going to see month to month versus the broader picture for the consumer. And I think the broader picture is, yes, retail is under pressure, and we're going to see it continue to be under pressure this year in terms of unit growth and pricing power. But when we look to retail sales month to month, there's a lot of swings because of the seasonal factors. And similar to what we saw in January, where there were unfriendly seasonal factors that caused that big downside surprise in January, we're expecting the same thing to hit April retail sales as well, and that's really dragging down that control retail sales number. So I think it'll be important to look under the details and see how much of that downside is due to seasonal factors versus actual retail sales.
So when you zoom out, what does the picture look like for retail sales over the course of 2024?
I think retail sales could be almost flat for the year. You know, very weak unit growth paired with price deflation. And so you're kind of muddling around between 0 to 1% retail sales, so very weak. Most of the resiliency in the consumer is going to show up in services. And that's just very clear, right? First quarter consumer spending data showed 4% services growth. We're tracking about 2.5 to 3% services for the second quarter, whereas retail sales is coming in 0 to 1%, much weaker.
All right, Sarah, great stuff as always. Sarah Wolf over at Morgan Stanley. Two big reports that we get tomorrow, those CPI numbers here on a month-to-month basis, 0.4 on the headline. Retail sales on month-to-month at 0.4% as well. That would be a deceleration, Scarlett, from the prior month. But a few other things that we need to set you up to keep an eye on over the next 24 hours. And let's start overseas. Vladimir Putin, Scarlett, I know you're a big follower. He'll be in China. Big meeting here with Xi Jinping.
Yeah, the president for life meeting another president for life. It's actually his first trip abroad since securing his 5th term. So I guess that's very symbolic, you know, the fact that he's going to Beijing and he's going to meet with Xi Jinping.
Yeah, I think he needs a few things here. It'll be interesting to see. There's a lot of talk about their relationship and how much that personal relationship will be tested by the war in Ukraine and some of the needs.
They have a no-limits
Putin
partnership, Romaine.
Well, that's what they say. We're going to find out maybe tomorrow, overnight here. And as we were just talking about back here in the U.S., we do get those two big data reports. What's most important to you, the CPI numbers or the retail sales?
The CPI number, as soon as it comes out, people will figure out what it means for core PC, which is the measure that the Fed really cares about. I think retail sales, like Sarah was just telling us, has potential to surprise. Don't forget also, we get other numbers as well, not just CPI and PPI. It's a bevy.
Manufacturing, we get business inventories.
Exactly.
Quite a few. So yeah, we're going to have a whole laundry list of macro things to keep an eye on. We do get some earnings as well, Scarlett, although I guess we're kind of in that, what is it, like the 3rd or 4th tier of earnings right now? Well, there's Cisco. They're kind of big.
Cisco's big because they'll provide us an update on corporate spending, on IT. Burberry will be interesting. It'll be yet another quarter of declining sales.
John Farrell will be really into that one.
And Commerzbank, the German bank, also expected to report. Analysts not looking for anything too groundbreaking there.
One day I went down to the Burberry down the street because I was like, I love a nice Burberry. I couldn't fit in this other thing. They're slim fit for everybody.
Really?
Yeah,
Interesting.
They weren't made for guys like me.
You want a trench coat? Is that what you're looking for?
No, I wanted a suit. I wanted to keep up with John Farrell, but I got to lose like another 40 pounds in order to do that, apparently. We're also getting the 13F filings. You know, the hedge funds have to make those disclosures.
And this is how you know that we're at the tail end of earnings season, right? When they tell us what they're buying or selling. It's actually a snapshot of a moment in time. It doesn't really...
Yeah.
It raises more questions than it answers.
It does. But I am curious. Do you think it's just going to be all like AI and chip stocks or something that they bought? Or?
I think that's going to be a big part of it.
Yeah. I was curious. I mean, I know it's sort of backwards looking, but it's always fun to just kind of see where they really bought
and who's on what side, right?
Absolutely. Be sure to tune in tomorrow. Scarlett and I will be back here on The Close for all your coverage. Balance of Power coming up next, right here on Bloomberg.